Welcome to the second of our client webinars, which is intended to just help share some of the thoughts from our investment committee. So today's presentation is entitled Investing in a Post-Pandemic World. So it's obviously very interesting times for everybody at the moment. We've had a year like no other last year. And then, of course, as the year rolled on, we started to claw back some optimism in financial markets, which has meant we're now at a curious position now where we're perhaps not out of the woods, but also things are not as cheap as they were perhaps six or 8 months ago. So I'll go through a brief introduction on today's agenda, and then what I'll do is pass you over to one of our expert consultants on the first Financial Investment Committee, whose name's Andrew Doherty. You remember from our last session, we had a speaker, Tim Farrelly, who's our other independent expert on the committee. So it's a really good opportunity to hear from Andrew. He's a very impressive sort of individual and a highly sort of valued member of our committee. So I'm sure you'll enjoy an update from him. And we'll also should have some time at the end for some questions and to sort of wrap up. So just a little bit of housekeeping with the Zoom meetings. Generally we can ask questions throughout, but it's perhaps there'll be a dedicated time at the end for questions that you could save up. If you feel something really is important to us right now, you can type it into the chat function, and we will be keeping an eye on that. And if appropriate, we'll answer it there and then, or we'll leave it to the Q&A session at the end. But either way, there'll be time for questions. Just also please ensure that your mute button is on. I know we have somewhere between 40 and 60 attendees today, so it's obviously important that the mute button is on. Okay to have your camera on though. It's really good to see people's faces and a bit of body language through these meetings. So it's okay to have that. Again, either type the answer. So either put your questions in the chat section and we could type the answers directly to you, or we'll answer them live at the end. Just our usual disclaimer to say that this is actually not personal financial advice, which takes into account your particular needs and circumstances. It's generic in nature. So, to apply this to your own situation, you need to speak to your advisor. Just another brief sort of overview of what our investment committee is, or the members in that investment committee. There's 9 practitioners or employees of the company that sit on the committee, and also 2 independent experts. We have a range of experience and roles within that committee. So we think it's a sort of valuable function in the business, and it does provide sort of guidance to all the advisors as to how to steer your investments. Importantly, though, we've got two very important independent experts, and the first one you'll hear from today is Andrew Doherty. So Andrew's background, he'll go through in more detail, but he's got a history as an investment banker, was in London, headed up Morningstar Equities for 8 years, and everyone will know Morningstar as a major research house. Was a research manager, Aspect Huntley, has a company called Insurinvest, which he's been the principal at for about 6 or 7 years now. And importantly for us, he really helps us deal with equity markets. Tim, on the other hand, he's probably more of a top-down macro guy. So he's what we mean by that is he's more into the economics, the global economics themes and asset allocation. But he's equally got an incredibly impressive background, including graduating from Harvard Business School and receiving medals in his engineering degree way back in the day. So an interesting year we had. March is actually one of the, Andrew might correct me, but in many markets was actually the worst single month we've ever seen. So there may be worse bear markets that we've seen, of course, but there hasn't been a month like March of 2020. On the ASX 200, we dropped something like 36% in the space of a month, and that was a similar theme as the world went into global lockdown this time 12 months ago. But what you saw was the remainder of the year, we sort of climbed this wall of worry. So a lot of people are saying a V-shaped event, but it probably looks more like a square root if you look at the mathematics part of it. But we've sort of climbed our way back to something that's not far away from where we were before the pandemic began. And you may have seen these, hopefully you can see that clearly enough. I may have made the screens, whoops, sorry, a little big. These tipping point charts are a way that we sort of try to get an assessment of long-term valuations in markets and just get an idea of, does something look cheap, fairly priced, fully priced, or overpriced? We define those things as just in relation to the risk-free rate of return. So we use term deposits for that. So if something's giving us a risk premium or a forecast return of 5% above term deposits, we call that cheap in a risky asset class. Somewhere between 2.5 and 5 is fairly priced, fully priced, and overpriced. So when we look back in April, which was the month after the worst month we've seen, even when we factored in a decline in earnings on shares, it was hard to not reach a conclusion that things look cheap in the long run. So that was one of the sort of helpful tools that we used to help us, check our sanity and make sure that we felt that, risk of these assets were worth holding on to. Obviously, there's a lot of uncertainty through these times, but these, sometimes it's good to take out the noise and just look at long-term fundamentals, and that's what these help us to do. So we look at this now, and it's a little different. We've risen, and it's probably not as obvious that some asset classes are cheap anymore. In particular, the US, which is the second column from the left there. We feel that the way that that's priced doesn't augur well for the next decade, but what these don't tell us much about is the timing of these market moves. They just sort of give us a long-term fundamental assessment of some, and I guess we have to use our other principles like diversification and the bucket philosophy that we're so passionate about to manage risk in portfolios. But this is another way to sort of try to avoid buying assets that are clearly overpriced. But it's not as obvious. There's still some areas we think that are fair value to cheap. Most areas actually, except for the US. And I thought this slide's a good one, and I won't spend too much time on the detail. But what it is really what feeds into those tipping point charts. So it looks at the different countries and regions and says, what do we expect over the next 10 years from now from those different regions? And it's the main thing I want to illustrate here is the return is not all about growth. A lot of people just say, look at, how fast do I think my shares are going to grow? And they kind of equate that to the investor's return, which is not telling the full story. The full story is you've got to look at, the income component or the yield of that return. With overseas markets, currency does play a role, but it seems pretty minor at the moment. But importantly, this one here, which is called a price to earnings ratio change, is a reflection of what you pay at the beginning of a forecasting period versus what you might be asked to pay at the end of the forecasting period. And we work out what is a reasonable PE at the end by what sort of bond markets are telling us. And that can have a big impact on your return. And I guess the US story is one where we're saying that at the moment you're asking to be paid sort of 33.1 years of earnings in that market, which is quite a lot, So, and we think just the fact that you're paying that much alone is one of the reasons why it's hard to, that market really has to perform well continuously to warrant a return when you're paying that much at the beginning. So again, without getting bored on the details, your advisors can take you through all of this, but we just thought that there's more than one component to return, and the US is an interesting story at the moment. So all of that leads us to what we think are the major themes that are influencing our decisions, and again, we tend to sort of distill a lot of the noise into just things that are useful for us in terms of what we can do with portfolios. And these sort of 5 themes have been fairly pervasive and persistent over the journey. We do think that it's getting more and more likely that we'll see this short, sharp shock scenario from the coronavirus as we roll out vaccines. That markets have clearly been thinking that way for a little while now. We've always had a low interest rate environment, but I think with the amount of debt that's around the world, this is again probably confirmed that thesis. May not be a rock bottom rates we see at the moment. It might rise a little bit if inflation takes away, but we're still not. When you compare to, I remember the 2008 Olympics. You could get an 8.88% term deposit because 8 was the lucky Chinese number. We're not going to see those days again anytime soon, I don't think. So that's where we're looking at. We've got to look at sort of riskier assets like shares and property to derive returns, but we've just got to be careful of how we introduce risk into portfolios. The US is a market we just with that 33 times earnings, it just becomes hard to justify paying that much for those shares. And there is a bit of opportunity in the defensive part of portfolios in what we call investment grade credit. So these are the themes that I guess your advisors will talk about still with regard to portfolio decisions. Again, we'll obviously monitor this as an investment committee from month to month and make changes if we deem it necessary. So what I might do now is pass over to our expert, Andrew Doherty, and he's got a presentation which just gives a really good insight into how we go about selecting equities on our approved product list, which then find their way into your portfolios. So with that, I will stop sharing. I believe, Katie, that's the right thing to do.
Yes, that's fine. And then, Andrew, you should be able to share your screen. Beautiful.
Okay, thank you, Katie. Thank you, Graham. And good morning, everybody. Thank you for joining us today for this session. And I want to say, I'm very thankful and happy to be working with First Financial and helping them construct portfolios for you, their clients. And I want to acknowledge that the last 12 months has been very tough for most of us, and we can now, with considering the fact that we seem to be getting more and more on top of the virus, we can look forward to reduced health risks and an improving economy, which really does provide a basis for positive returns from equities. But as Graham was alluding to, shares aren't, the market in its entirety is prohibitively cheap. So we need to be increasingly careful about which stocks we do own. So what disclaimer here is that this is general information, so it's not personal advice, but of course you'll speak to your First Financial advisor to help with your individual decision making. And so I've got quite a few things to work through in the next half an hour. I'll just briefly talk about my business at Assure Invest and the overall approach to investing, which does have successful outcomes. We'll talk through the favoured 40 process. So the favoured 40 is a key research product that I provide and service that I provide for First Financial's investment committee. So it kind of looks like that. And it's a list of the favoured stocks in the Australian market that the advisors can choose amongst in helping construct portfolios for you. So the key is that I work through developing this list of the best companies to invest in, and then I put that forward to the First Financial Investment Committee, and then after a discussion process, they may be approved as potential investments for you, their clients. Then we'll talk about the market outlook, observations from the recent reporting season. So, most Australian companies release half-yearly results, and through February, most companies release their results. So there's some interesting insights to talk about. And then we'll have some company examples and discussion. So my background is over 20 years of investment experience. I was head of equities at Morningstar for 14 years. and before that. So I've just always loved investing. So it's been a passion of mine. And I think if I wasn't actually working in the investment field, I'd be doing it. I'd be doing investments as a hobby in any case. So 6 months after I started working full time, I bought my first shares and just really loved that experience. So to look at, so I'm running my own portfolios as well as helping First Financial with their portfolio construction. I run my own portfolio set. And so just as an example of the outcomes that can be achieved, I've got a long history of outperformance. So since February 2014, when I started the Shore Invest Australian equity portfolio, it's outperformed the market by 2 or 3% per annum since inception. In the 12-month period or the calendar year of 2020, that the portfolio returned 7.5% compared to 1.4% for the market, and it's held up quite well in the last few months as well. So let's look at the big picture in terms of the approach to choosing stocks, which should, number one, preserve capital over time. I mean, and that point is so central, isn't it? We don't want to. The whole idea of investing is to grow wealth over time. So we don't want to risk capital loss, and that perspective is so instrumental. So it means that you do. As my experience is that you focus on high quality, and that means that you have less risk of major losses in a portfolio, which might create big holes that are hard to fill in as time goes by. So really it is about finding the very best companies and finding them at a reasonable price, which helps you preserve capital but grow wealth slowly and steadily over the many years. So as you can see, the approach is to find that subset of companies. It's a rare subset, those that are outstanding companies that are also trading at a reasonable price. So often the market's quite aware that, oh, this is a great company that's just keeping on performing well. So they're often on very high valuations. So you have to be careful and patient so we can snap up opportunities to buy these companies when there are chances offered. So the kinds of characteristics we look for when we're finding outstanding businesses are the presence of sustainable competitive advantage. So I'll talk more about that in a few minutes. Essentially, it's about finding companies that have unique assets that really set them apart from the competition and allow them to achieve strong profit growth for many, many years ahead. So we want some growth potential. We want strong cash flow generation ability, and we want strong balance sheets and management who are focused on building value in the business. So we want to find those businesses that are offering attractive value. And as with everything in investing, it's a combination of science and art when we're picking investments. So we use a range of factors to work out if there's value in a share price, things like earnings multiples, price to book measures, free cash flow yield, which I think is a really helpful measure. It's where, free cash flow is the cash that's left over after you start with revenue, subtract all the running expenses of the business and all the capital that's required to maintain the business. What you have left over there is the funds that are available for, number one, either paying out dividends, which is obviously a key source of return for investors, but also funds to invest in the business for new growth. And dividend yield is a very helpful guide as well. So just the ability of a company to pay out strong, reliable dividends is a key marker of high quality and value. And the wheel here on the left-hand side of the screen there shows the process that I go through in constructing both the favoured 40 list and my own portfolios. If you start at 1 o'clock, screen through the ASX 200, so the largest 200 Australian companies, I screen through the fundamental data. So things like earnings per share growth, margins, historic sales growth, return on equity, other measures to help guide to quality and value. And from that list, I'm trying to whittle down the ASX 200 to a subset of companies that I think are investable. And there's really only, I think it's a key statement, there's only 40 companies in the ASX 200 that I would really seriously consider investing in. So as you can see, it's just the minority of companies that are special enough to allocate our investment funds towards. So I developed the favoured 40 list, which is about working through that universe, doing more research into them constantly, updating data, updating the analysis, and whittling away to get down to a list of 40. And that evolves over time as valuations change and as the outlook changes and as conditions for each of the companies changes. And from that point, the process breaks away. So I deliver that favoured 40 list to the first financial investment committee, and then we work out which of the stocks should go on the approved product list for portfolio construction for your portfolios. Then the advisors do more research, and at the same time, I'm doing more research into these companies, and I work out which of those 40 go into my portfolios. And it's the same on the other side. Your advisor is working away to work out which of the favoured 40 should go into your portfolios after consultation with you. And so let's talk about competitive advantages and the types of businesses that we really strongly prefer. So what we're looking for are companies with unique assets and skills that set them apart from the competition and allow them to succeed over the long run. So they often have strong industry positions, and they might be strong, like high barriers to entry. You might so there's limited rivalry. So that's a good situation for a company to be in. So for example, there might be huge costs involved in getting into an industry and establishing a sizable position. And if that's the case, then that's an advantage for the company that's existing in that industry. We want to see companies with strength over or power over the consumers. Like strong brands are often an indication of power over consumers, where consumers just keep wanting to come back and buying the same brand over and over again. That's a very powerful situation to be in for a company. So we want to find these wonderful companies with strong industry positioning, but we also prefer to have companies that are have reliable earnings and predictable cash flow. And so that means that they're more transparent, we can understand them more, we can work out. So that means we're more likely to be able to work out what they're worth. And once you know what they're worth, at least in your own analysis, then what you want to do is seek to buy them at a discount to what they're worth. And that's how you create value over time as investors. So we look at business risk, and that's determined by how cyclical the revenue stream is. So we prefer to have a revenue stream which is structurally growing, so just growing no matter what the economy is doing. We prefer that they have quite low operating leverage, so we prefer that earnings don't swing around in a dramatic sense in relation to what revenues are doing, and we want to have strong balance sheets. And in terms of the key sources of competitive advantage, you can break them out into these four major categories. So there's cost advantage. So examples are, say, supermarket retailers like Coles and Woolworths, or big resources producers like BHP. They have the advantage of scale and cost advantage. So they can produce at lower marginal cost relative to their smaller competitors. So that puts them at the advantage of potentially profit margins and the ability to actually even cut there. Then second source of competitive advantage to mention is differentiation advantage. Now, this is actually quite rare for Australian companies to have. A key example there is strongly branded products. It's actually a little bit unusual in this day and age anyway, for companies to be able to actually produce really unique products that are hard for others to replicate or have comparable products. But if we can find them, and I think examples in the market are ResMed, which is a sleep apnea products and services provider that has a suite of highly appreciated and highly valued products, and people once they start using ResMed products, they're more likely to keep using those products and services. And also Invocare, which is a funeral operator, has strongly branded services. And then switching costs. Examples there are where, often an example is a computer system. We take a lot of effort to get used to a new computer service or new software, and we don't like to shift unless we really have to because of all the perceived time and energy required to get to learn a new computer system. And I think examples are the banks, where customers are very sticky. People tend to stick with the same bank for many years. And I've got the same bank account that I opened as many years ago now, and I haven't switched banks in all those years. And Medi registry, another example of where companies, once they start using registry, time and expense required to switch. And then the fourth source of competitive advantage to mention is the network effect. So this is where the more powerful it becomes. And so Facebook and other social media are examples there, but also in our market, car sales, which is the leading classifieds business for buying and selling new and used cars, is a great example. It's very hard because most people use car sales websites to buy and sell vehicles. It's hard for a competing network to get up and established. And Seek is another good. So the online jobs market, Seek is very well established and hard for competitors.
Sorry, Andrew, we're just having a little bit of difficulty, I think, with your internet connection. So apologies, everyone. Hopefully you can hear clearly at the other end.
Is it better now?
Yeah, that is better. It just sort of intermittently
Okay.
dropping in and out.
A bit unstable.
Yeah. Anyway, we'll push on.
I'd suggest just drop video, Andrew, and that will fix the problem.
Drop video?
Yep.
Yeah, maybe stop the video, it might help. Yeah.
Is that something I should do, Grant?
Andrew, if you stop your video, that might help with the bandwidth coming from your internet.
Oh, I
Your
see.
slides will still show.
Okay.
So your slides will still show,
okay.
but just turn your camera.
Yeah, okay. Yeah, gotcha. Hang on.
Hello? Oh, are you there? Are you there? Because,
Duy.
if your brother em lúc nào nó bébé nè.
Yeah, but no, but
All right.
Sorry, we're just having trouble finding.
Just down in the taskbar is a camera icon down in the. Yeah, perfect.
That's perfect.
Okay. Okay, yep, got it. Okay, so now turn to the construction process for the favoured 40. Just quickly, there's quite a few measures here, but just to get a sense of how we do this. So first of all, looking for high quality companies, as I mentioned. So we do a ranking system based on whether there are competitive advantages, and yes or no, and then we prefer companies which are lower business risk. We want companies with strong return on equity, and to get into the favoured 40, we'd strongly prefer that return on equity is above 7%. So return on equity is the profit the funds invested by shareholders. and we want strong balance sheets, and there are different health measures, earnings divided by the expense, the interest expense. And we want to see, in terms of valuation measures that we use free cash flow yield, strong raw yield above 6 indicated. We PEG 1, so PEG is earnings per share growth rate. So the higher the growth rate in earnings, the lower the PEG ratio should be in relation to the PE ratio. And dividend yield is a good indicator of value. So a higher dividend yield might indicate there's value there. And then also run my own quantitative model where I forecast innovation. And now let's turn to the Australian equities market outlook. And so we can, along with low interest rates, it's since this time last year in equity prices, but I think that just the fact that we're still moving from a very deep recession.
Sorry, Andrew, you're still dropping out there for
last year, and growth out of that does give impetus for. Okay, I'll just log out of the internet and back into it. Sorry about this trouble, everybody.
Thank you.
Okay, hopefully that's better. Is it okay, Katie?
So far, so good. Thank you.
Okay, I could just maybe, yeah. Okay. So the emergence from the very deep drawdown in global activity in the first quarter of last year, we're still growing out of that, and as we more and more come as mobility increases with vaccines rolled out, we should expect growing economies and therefore growing earnings, and that should lead to positive returns from equities. But we must say that because we're starting now with fairly high equity prices and also steepening yield curves, so as inflation rises over the next few years, yield curves should steepen a little bit. It's going to be a little bit of a challenge for equity prices over time. So the fact that we're starting with relatively high valuations, and we've got the challenge of higher, steeper yield curves, that'll mean that projected returns from equities are a little bit lower than might otherwise be the case. But certainly we can see that consumption should be a key driver of growth over the next 2 years or more. We're starting here with high savings rates. People were constrained from activity in the last 12 months, and with all the income support measures and low interest rates, many people have saved more than they normally would. So people are ready to spend, and generally, of course, there's some disaster stories, unfortunately, but generally people are ready to spend with stronger household finances than 12 months ago. There should be also a strong impetus for spending as a result of the residential construction cycle, which looks like it's going to be quite bullish over the next couple of years, and as a result of new house construction and rising asset prices, that does lead to more people spending more money on goods for their homes. And of course, an overarching focus of our individual company selections is on high quality companies, but I have in the favoured 40 and also my own portfolios, we have selected more companies that have cyclical exposure, so they'll benefit as the economy does recover. But it's so important that we're focusing on high quality cyclical companies, not junk. And interestingly, there's still valuation gaps between the health crisis winners and losers. So some of the winners are online retailers because people were at home still buying goods. But some of the losers were some of the service providers and, of course, international travel service providers. And so there's interesting valuation gaps between some of these companies that have done very well in the last 12 months. And so often their valuations are quite excessive. But there are still those companies who are lagging because the current conditions are still weak for them. But there's opportunities to buy some of those companies, seeing that their earnings will recover quite strongly in the next couple of years as vaccines are rolled out. So here are key investment themes to focus on when we construct portfolios. And number one is the fact that we're recovering from the pandemic, and we see that after spiking, especially during the northern winter, new virus cases are dropping quite dramatically internationally. Of course, we've had a good record here in Australia broadly. But the vaccine rollout is quite aggressive, particularly in America, where it's quite possible that herd immunity will be achieved by June or July this year. They're very aggressively rolling out the vaccine. And Europe and Australia are a bit behind that, but by late this year or early next year, Europe and Australia will be in a good position. And so that's leading to increased mobility and as such, increased activity, especially amongst services, because people were constrained from interacting in a face-to-face way, and therefore constrained from some activity. And job recovery is so crucial too. So jobs are recovering quite quickly. It might take another year or year and a half for unemployment to reach where it was before. But jobs are being recovered quite strongly, and this of course leads to stronger incomes and greater confidence for spending. Point two is that international monetary and fiscal policy is remaining expansionary. So governments proved to be very generous. This time last year, there were lots of income support measures and generous lending programs implemented to really support the economy in Australia and Europe and the US and Japan, support the economies through this crisis and help deliver a recovery when the virus was in better check. And yeah, governments were shown to be very willing to increase debt levels substantially. And of course, the US has just announced a new $1.9 trillion US dollar stimulus package, which includes $1,400 checks to many people across the US, and that they'll be delivered over the next few weeks. And the central banks are also very aggressive, cutting interest rates to zero where they were above zero, and embarking on or increasing quantitative easing or bond purchase programs to reduce longer term interest rates. And this helps to reduce borrowing costs and make it easier for governments to fund their spending programs, and also encouraging more activity in the private sector. And central banks are showing that they will be very patient in terms of reducing the stimulus that they have out there already. So the Reserve Bank and the US Federal Reserve have both indicated that they won't raise rates for 3 years, and they're showing stubbornness in that plan. I think they're seeing here an opportunity to not waste this crisis and finally get inflation higher. So as you'll know, for the 10-year period after the global financial crisis, inflation's been below target levels for central banks. And there's been a lot of structural forces weighing down on inflation. But here is an opportunity, I think, that central banks see to finally get inflation up into their target area by keeping rates very low for much longer. And as demand comes through, prices should eventually rise. And a key point three is inclusive and sustainable growth. So in that 10-year period after the global financial crisis, generally governments were constrained on their spending. The central banks were quite aggressive in monetary stimulus, and that has exacerbated this problem of wealth inequality, where individuals that were able to own assets were becoming wealthier, but those without were being left behind. So this is a problem that I think is much more, or the political classes are much more aware of this problem, and it seems like they'll be doing more to address those problems through more public housing projects and health supportive healthcare measures, and also help for job creation. And then point 4 is that inflation should keep on rising, and inflation expectations have actually risen quite a bit in the last 6 weeks in the market, and we've seen a big jump in bond yields in the last 6 weeks. But even so, I think that inflation is going to rise in the next 2 or 3 years, helped as demand rises, ongoing stimulus, and commodity prices have really lifted quite strongly. Commodity prices generally are up more than 25% in the last 12 months, so that's going to add to broader inflation. And a key point also, the last point, is that innovation is altering competitive landscapes. We see these wonderful businesses using latest technology, using mobile apps and websites, and new innovations that are making it hard for some pre-existing companies to remain competitive, but also giving great opportunities for companies to use these innovations to their advantage. So we do have some of these companies like Seek and Car Sales and ResMed in our favoured 40 list. Now, some observations from the February 2021 reporting season. So earnings really showed the starting point of the rebound from the pandemic drawdown in the economy. So earnings largely were in line or above expectations. Resources really were a highlight, where there's a strong lift in profits amongst the large resources producers, helped by rising commodity prices and very strong cash generation and strong debt pay downs. Banks were helped by stable net interest margins and reducing provisions. So it shows that banks increased their provisioning for doubtful debts through last year, and it shows that they're overly conservative. But now, interestingly, bank management are much in control of their own earnings profile, where they can now reduce the provisioning and which adds to the earnings per share, and allows dividends to be increased. And many brokers have raised their forecasts for company earnings after the reporting season, and this shows increasing confidence amongst investors and the broader community in terms of the outlook for our economy. So balance sheets were broadly strengthened, as displayed during the reporting season, helped by rising revenues and previous cost cuts and last year's cuts to dividends and the raising of equity, which helped to shore up balance sheets. The pandemic winners and losers were obvious through the reporting season, where those that produce goods like the online retailers and electronic retailers had very, very strong profit growth. So JB Hi-Fi did well. Bunnings, because people are doing up their homes, did well. Domino's, because people were at home ordering pizza. But services did less well, of course. So especially travel, etc., which were hurting by the stay-at-home period. And the earnings guidance, companies are still a little vague or not providing guidance. Where it was provided, it was a bit more positive than it was in the previous reporting season, though. Dividends were either lifted or left flat, and payouts were increased, especially amongst the big resources producers, BHP, Rio and Fortescue, and banks also raised their dividends again after reducing their provisions. And margins held up well again helped by the sales increase, so rising volumes, but also prior cost cuts as well helped. But there was some evidence of input cost inflation, which is a concern in some areas and probably going to be an increasing concern in the next couple of years. Commodity prices, increased freight costs, etc. We're on evidence. So, so in the last segment of the talk here, I'd like to highlight three companies. Now I'm aware that there's 10 minutes to go. So 3 companies I'd like to highlight as examples of the companies in the favoured 40 and on the approved product list. First of all, GUD Holdings, which is a supplier of automotive aftermarket products and also water products. Most of its sales are from automotive aftermarket products. Many of the brands that it supplies are strongly branded, and that gives them the key benefit of pricing power. So they're able to pass on cost increases to their customers through higher prices, and so that's a key source of added revenue growth. But many of the products that they do distribute are also commoditized, and also we need to be aware that some of its customers are very large retail chains like Repco and Supercheap Auto. But they have a very good record for product development and bringing in new products to distribute, and this adds to their efficiencies, their scale benefits. And they also, over time, since they've got very strong cash generation and a solid balance sheet, they're able to acquire smaller companies that add to their growth profile. So the investment case for owning the stock now is that earnings should lift very strongly in the next couple of years. And you see there, I know there's a big table on the right-hand side filled with numbers, that if you look closely in there, you'll see that earnings per share growth, EPS growth, might be 40% this financial year and 11% next year, helped by the lift in overall economic activity, but also the strength of domestic tourism, so people are driving rather than flying, and people are less inclined to use public transport at the moment. But longer term, sales are very much linked to population growth and the growth in overall car ownership. Margins are being improved through volume increases and price rises, and the stock's on quite a modest valuation compared to many in the market. So the price to earnings ratio of 18 times this current financial year's earnings or 17 times next year's earnings, it really understates the prospects for earnings per share growth, which I think will average 15% per annum over the next 5 years. So I project a total return for holding the stock now of 10% per annum. It's capital growth plus dividend in the next 5 years. Then Amcor is a very high quality company, and interestingly, relatively cheap on the market right now. And I think some of the more boring, reliable companies are relatively cheap at the moment, which is very interesting, I think, because people have been chasing these high-flying tech stocks or more of the resources type stocks, and they've been ignoring companies like Amcor, which are very reliable, highly transparent, and very good quality names. So Amcor is it's a producer of packaging products, both rigid and flexible packaging products. It's got very extensive global scale, which provides advantages over smaller rivals, and also makes it more likely to win contracts from very large global product manufacturers. It's able to boost its productivity over time through innovation and capacity expansion. It's got a good record of passing on cost increases to its clients, showing that it's got good strength over its good negotiating strength with its customers. It's got a very strong balance sheet. It's progressing well through the current financial year because there's been a sustained demand for essential food and beverages and healthcare products. Sales growth is not overly strong. The first half sales of flexible product sales were up by 1%, but 9% up for rigid plastics, which is quite a good performance. So sales growth is unlikely to be very strong. I'm expecting about 2 to 3% per annum sales growth over the next 5 years on average, but it does have great prospects for margin expansion through cost savings measures. And it did a major acquisition a couple of years ago of Bemis, which was also a very large player in this market. And the combination of those two companies does produce very strong potential cost savings, and they're aiming for $180 million worth of cost savings annualized from the work to integrate those two companies. And yeah, very modest valuation considering the strength of this company and its earnings profile. The price to earnings ratio is only 15 times, and the yield is over 4%. And finally, Medibank Private. So that's one of the larger Australian private healthcare insurers. It's got 3.9 million clients through its Medibank branded insurance services and the AHM brand, which is it's targeted towards youth and lower value clients. So it benefits from scale advantages over smaller rivals, and its large scale ensures that it has at least an even battle with the large private hospital operators. It benefits from switching costs. So like a computer software service, once people take up private healthcare, they don't tend to switch providers. And it's got ongoing support from governments who really need to have a thriving private healthcare industry to help them support the nation's healthcare costs. Its balance sheet is very strong with no debt, and so it's very well positioned to grow through acquisition. In terms of the investment case for buying the stock right now, it's been able to lift its number of policyholders impressively, I think, considering the troubles with affordability that are present. The AHM brand has been growing market share, and the core Medibank brand has also been growing policyholder numbers, I think helped by reduced out-of-pocket expenses and a suite of new services provided amongst the offering. And supportive longer-term industry forces include a growing and aging population. So again, a modest valuation considering the reliability of earnings growth. The price to earnings ratio is 19 times, the yields over 4%. Well, thank you. That's the end of my presentation. I've run a bit over time, I'm sorry, but are there any questions?
Haven't got any through just yet, Andrew. Just give it a couple of minutes.
So for those who'd like to ask questions, obviously, firstly, you might need to unmute your button, but if the chat functionality down the bottom of it, if you were to type in, yes, I have a question, it will bring your name up and we can then ask you about your question and unmute you. So hopefully everybody can see the chat function at the bottom of their taskbar.
There's a question there from Emma and David Smith, Graham, if you can see that, and you might like to turn your camera back on also.
I will. Thanks, Emma and David. So the question from Emma and David is, my question relates to the Australian dollar exchange rate and the likely impact on investment decisions. I might tackle that first and then perhaps get Andrew's expert commentary. I think, so currency is something we tend to look at mostly in relation to our international investments and the impact that currency might have on international shares in particular. We have a currency policy here, which your advisors would know that typically we have what we would call a neutral stance on currency, and then we have an active stance when currency gets to extreme valuations, and we use a thing called purchasing power parity, or some might call it the Big Mac index, which is effectively the parity between the cost of goods and services in one country versus another. So if that purchasing power parity gets dislocated, that might imply that in the long run, that currency might move in a particular direction and we might take an active position. But if there's no such indication, we'll take a neutral stance on currency. But certainly currency does impact international investments, but it's not easy to, it's very, very difficult to predict in the short term is what we've found. And so therefore we use a more long-term indicator called purchasing power parity in order to guide those decisions. I might pass to Andrew and see if he has any other comments.
Well, yeah, I mean, currency is, as Graham is saying, currency is very hard to predict, even short term or long term, I think. And I think that it obviously does have implications for very short term earnings for companies. So depending on where their operations are and where their sales are and what currency they're in. But I really find that, and again, we're talking about long term investments here, and exchange rates do fluctuate in the short term quite widely. I actually find shifts in exchange rates an opportunity to either buy or sell a company. So just recently, several companies that generate a high proportion of their revenue in US dollars have been a bit weaker. Like healthcare stocks come to mind. They've been a little bit weak in the last few months because the Australian dollar has rallied relative to the US dollar. But I see that as an opportunity to be looking to buy more of those healthcare stocks because their valuations are a bit more attractive now. So using short-term shifts in prices to make longer-term gains is the approach I take.
So hopefully Emma and David, did that answer your question? I don't know, Katie, can you unmute Emma and David by any chance?
One moment. Yes, unmuted.
Are you there, Emma and David?
Yeah, hi.
Yep.
Just that it seems that the Aussie dollar value would have an impact on a number of Australian companies, and I just wanted to know how that was taken into account in decision making. But your comments are taken on board. Thank you.
No problem. Yeah. I think maybe resources as well, Andrew, while we're on the topic of currency resources, commodity prices tend to have a bit of an impact. We obviously have things like interest rate differentials between countries. But I think in Australia, commodity prices have typically had a bit of an impact on the Australian dollar.
Yeah, and I think that, and again, actually, commodity prices are hard to forecast and have reliable forecasts on because they're naturally so volatile. But I'd expect, and commodity prices have risen so strongly in the last 12 months, but I do expect further appreciation. And I think that inflation and interest rates between the US and Australia are going to be quite similar. So I think if commodity prices do continue to appreciate, that's going to drive the Australian dollar that much higher in the next 12 months again.
Thank you. Is there any others, Katie? Any other questions from the?
Nothing else has come through direct to me.
Okay.
Graham?
All right. Well, that may be all. I think we're okay for time as well. Katie, is it?
Yeah, we're just slightly over. So
look, I'll probably take the opportunity to thank everyone who attended today. Appreciate the attendance. We're obviously doing a few of these Zoom webinars, and we hope that you're getting something from them. I would like to thank Andrew in particular for his expertise and everything, and as an investment committee, we find his input extremely valuable. As you probably tell it through his presentation, he's got an extensive wealth of knowledge in equity markets, and that's something that's very valuable to us as a firm. So without further ado, I think that would be the end of the of today's webinar. But again, thanks to everyone for attending. There will be a link, Katie, if I'm not wrong, to a copy of today's presentation if anyone would like to go back and watch it over again. But otherwise, thank you all for your time.
That's correct, Graham. That's going to be posted on our website shortly.
Yep. Okay. That's all. Thank you.
Okay, thank you all.